Lombard Credit Hook. Unlock liquidity without selling. Imagine you own a portfolio of investments, funds, bonds, maybe some equities, and you suddenly need liquidity. You could sell part of the portfolio, but selling can be slow, can lock in losses at the wrong time, and may trigger taxes. A Lombard credit is a different approach. It lets you borrow against your investment portfolio. In simple terms, your investments become the collateral for a loan, so you can access cash while keeping your portfolio invested. What it is, plain definition, a Lombard credit is usually structured as an overdraft credit line linked to a current account, secured by a pledge on financial instruments held in your portfolio. Two key ideas to remember. Collateral is the portfolio. The lender takes a pledge over eligible securities, like certain bonds, funds, ETFs, and sometimes equities. It's rotating. Many versions allow you to change what sits as collateral over time, so the set of pledged investments can evolve as you rebalance or trade. How the money amount is determined. Haircuts, LTV. Here's the crucial part. You don't get 100% of your portfolio value as credit. Because markets move every day, the lender applies a safety margin, often called a haircut. So the maximum credit is based on the market value of the pledged investments minus the safety margin. What does that mean in practice? If your collateral is considered stable and liquid, you may get a higher percentage. If it's more volatile, you get a lower percentage. Some product descriptions show examples where a portfolio of 100,000 can translate into 60,000 of credit, and in some cases the margin can vary within a range depending on portfolio risk. What you can use it for, and why people like it. Typically, the credit is not tied to a single purpose. It can be used for many needs: bridging short-term liquidity, covering a large expense, or timing a purchase without selling investments. Find it attractive. Speed and flexibility. You may access liquidity quickly once the facility is active. You avoid selling. You keep market exposure instead of liquidating positions. Portfolio management continuity. With a rotating pledge, the collateral can adapt as the portfolio changes within eligibility rules. The big risks, simple, no jargon. Now, this is important. Lombard credit is not free money. It's a loan, and it comes with real risks. Risk number 1. Leverage effect. Borrowing increases the risk-return profile of your overall wealth. If markets move against you, losses can feel bigger because you still owe the borrowed amount plus interest. Risk number 2. Market drops can trigger a top-up request. If the value of the pledged investments falls too much, the lender may ask you to add more collateral or repay part or all of the credit. Risk number 3. Forced selling at the worst time. If you can't add collateral or repay when requested, the lender may have the right to sell some or all pledged investments to restore coverage, potentially during the market drawdown. Risk number 4. Concentration makes it worse. If the collateral is not well diversified, coverage can deteriorate faster in stress scenarios. Diversification is often highlighted as a key mitigant. A simple, safety checklist, plus closing. So when does it make sense to even consider this tool? Here's a basic safety checklist. Know your buffer. Don't use the maximum available credit. Leave room for market swings. Understand collateral quality. More volatile assets typically mean lower credit availability and higher risk of coverage calls. Plan your exit. Have a realistic way to repay without being forced to sell at a bad time. Read the key clauses, especially what happens if collateral value falls and what rights the lender has in that case. Closing line. A Lombard credit can be a useful liquidity tool when managed conservatively. But because it's leverage backed by market-priced assets, the risk management part is not optional. Use it only if you fully understand what happens in a market downturn.